Well, good morning, everybody. Thank you so much for joining us. This is Pauline Chung. I'm the Director of Communications and Marketing with the San Mateo Area Chamber of Commerce. We've been holding these business essentials meetings since the pandemic started. We had our educational program was a once a month lunch and learn where we got together, actually had lunch together, networked. So we pivoted to half-hour sessions. Business Essentials, we held about 50 of them last year. So we're picking up this year in January, all wonderful topics, either business tips or sometimes they're just personal growth topics. So if you're a speaker, do you like to speak? Just contact me. I arranged the speaking series. Yeah, so today we are joined by two people that will be presenting to us today, George Wellmer and Anoop Nagendra, demystifying the art and science of business valuation. So tongue twister for me this morning, not enough coffee. And they met when they were in grad school in Spain. I thought very awesome. And George has a startup that he'll tell us a little bit about. And Anoop works for, different company right now. I can't read it.
Connectivity Capital, right?
That's it. Yeah. So, during COVID, people have been trying to figure out how much their business is worth. How do you do this? So we will get some tips on how to do business valuation today. So I ask that you stay muted during the presentation. They will be sharing their screen. Use the chat function if you have any questions. Since we have two presenters, they will be attending to the chat. And so that I'll turn it over to George to start.
Perfect. Anoop, you have the presentation lined up? Okay, perfect. Well, thank you guys for all coming from all parts of the country and the world. So this has been fun to see everyone there. Today we're going to be talking about business valuations, but in the sense of more for small and mid-sized businesses and less so about startups and publicly traded companies, although a lot of what we're going to be talking about is applicable to all businesses. There we go. So I'm George. I'm the founder of Ennerate, which is a startup that provides valuation services to small and mid-sized businesses. Prior to that, I worked for the Small Business Administration, startup, banking, so kind of all across the board. And then presenting alongside of me is Anoop.
Yeah. Hey, everyone. Thank you for joining us. Really appreciate your time this morning, evening, night, wherever you're logging in from. So I'm currently working with the world's first impact investing fund focused on expanding internet access to people that don't have it globally. Interestingly, I'm not wearing that hat for my presentation today, but some of my previous roles that I've played are in venture capital and transaction advisory. So I've been at a firm in India helping startups grow, and also at a big four accounting firm kind of helping valuations on the buy and the sell side. George and I, as Pauline mentioned, met at ESADE Business School in Barcelona, where we kind of shared a passion for entrepreneurship, strategy, and finance. So we're kind of hoping to leverage our experience in the sector and help aspiring business owners who are looking to value their businesses and entrepreneurs who are probably looking to grow their businesses, sharing our tips and experience along the way. We do want to understand why you guys are here today, and we've speculated a few reasons. So you probably have a business that you're looking to sell. You probably are interested in buying a new business. You thought that this tongue twister of a presentation title was interesting, and you decided you just wanted to understand how to value your business. Or like Michael and Angeliki, you're probably just our friend or relative tuning in to support us. So all of you are welcome. Thank you for joining us. Please let us know in the chat box if you're hoping to learn something that's out of these 4 boxes, or if you logged on here today for some other reason. It'd be helpful also to understand what your role is, and so that we could kind of network towards the end. We have 3 main takeaways that we're hoping to impart today. I will take you through kind of the introduction and an overview of the 3 main methods commonly used by investors to value businesses. George will then step in to take you through a step-by-step explanation of the process and the method with examples. And we'll zoom out again into the key drivers of company valuation. So probably a good place to start is by defining the word. I will throw up the definition here, but I do want to concentrate on those highlighted words. Valuation is a process. It's not, as most people perceive it, a number. So it's not a destination. It's more about how do you get there. It's the use of established analytical methods and preset assumptions. So it really is the combination of the quantitative with the narrative or the story that you're presenting to an investor. And it's an estimated value. So we like to think of it as an opinion. Different opinions have different weights, of course, on who's conducting it, but all of them are a bit subjective and a bit objective. So it's essentially finding out the value on a specific date. And so this indicates that valuations are changing constantly, and those factors, day by day, month by month, or like in an event like we are today in a pandemic, valuations you'd probably see are suppressed or just changed depending on the industry you operate in. A lot of you have probably seen this graph. It's a very typical life cycle of a business, and valuation triggers happen throughout this life cycle. We're kind of going to look at where you'd probably require a valuation in each of these phases. So as a new startup, you probably are thinking of maybe starting your own business, or sometimes you're buying a new business. That could be a trigger for evaluation. Perhaps you're looking to add an owner, or you're looking to obtain seed capital or SBA financing, as George would attest. Maybe you're looking to create your first employee stock option pool or value your intellectual property. All of these are events when you probably would consider how to value your business. Similarly, in a growth stage, you probably are looking for new equity financing or looking to get commercial bank financing. These two events, probably one of the two events that we see most commonly for valuation events. And then there's also tax purposes. So kind of right now, as the administration is shifting from the Trump to the Biden administration, there's a lot of changes in estate and gift taxes, for example, that have very material implications on businesses. Similarly, investment bankers also conduct valuations during an IPO. In the maturity stage, it's interesting. Businesses we've seen can go three different directions. So you could either choose to reinvent, exit, or you decline naturally in the course of the business. In each of these events, they present different options. So perhaps you're looking to change ownership, change the strategy, reinvent the business. That's a valuation event potentially. If you're a founder that's been in the industry for a long time, is looking to exit, you're probably open to a merger and acquisition, and that's an evaluation event. Maybe you're looking to bequeath your business to your sons and daughters, and estate planning is a very important valuation event. And in cases where, worst case scenarios, you're getting divorced, maybe your business is bankrupt, or you're going through a litigation. All of these are potential events when you'd consider valuing your business. At this point, it's probably also important to distinguish two important concepts: an asset, stock, or sale purchase, and an asset sale or purchase, and a stock sale or purchase. These two concepts are important, and owners usually have a choice to decide between one of the two. In an asset sale or value, you're valuing the individual assets and the liabilities, and the ownership of those assets alone is transferring to the buyer, but the seller is retaining the legal entity of the business. This is usually labeled cash-free and debt-free because it usually doesn't include the cash assets of the business, and the seller usually retains the debt obligations. For this reason, it's a preferred method for buyers who also frequently use this method to accelerate depreciation and step up, their depreciable assets. And there's a very favorable tax structure for the buyers. However, it's important to note that this method, you probably have to work to renegotiate the contracts on the asset, and usually you have to compensate the seller. In the stock sale or value, you're valuing the shares of the owner and you're transferring the ownership of the legal entity from the seller to the buyer. All the assets and the liabilities included. It's usually much easier and less complex. And it's what sellers prefer because, again, there's a taxation implication and they assume less liability in a stock sale. So to intro into the 3 different valuation methods, you probably see that these are the 3 most accepted methods. It's also what's defined by the Corporate Finance Institute. So there's the cost or the asset approach, there's the market or the relative approach, and then there's the intrinsic or the income approach. So at the outset, these are the main 3 methods that we'll be covering in the presentation today. George will take you through each one of them. But at this point, it's important to note that valuation typically uses one or a combination of these approaches. It usually results in a range of values, and we'll cover that as well. And a valuator or the business owner would decide which method to use depending on which is most accurate and also most representative given the company's unique situation. Each method, as you'll see, has its own advantages and disadvantages, and some definitely require professional guidance. To take you through each one of them, I'll hand it over to George.
Thanks, Anoop. The first valuation method that we're going to go over is the cost or asset approach. And what this does is it derives the fair market value of the net business assets. It's applicable for companies who are asset heavy or who have negative financial metrics. The pros of this valuation method is it's simple and quick. The cons are if you want to get an accurate assessment of obscure machinery or other things you have that are unique in nature to your business, it'll be costly to hire an appraiser. From a calculation standpoint, what you're doing is you're restating the assets and the liabilities from the book value to the market value to assess what you can get for it on the fair market. We have an example that we're going to present here. Camila Gonzalez, she'll be coming up throughout the presentation, and I'll walk through the example with you guys. So Camila owns a small plastic manufacturing company and is looking to exit the business quickly due to personal reasons. She expects to receive 100% of her receivables and pay 100% of her payables. Her fixed assets, PPE, property, plant, and equipment, not personal protective equipment at this time, have a book value that's 20% below the market value. What's the value of her business using the cost and asset approach? So the first step of what we're going to do is we're going to bring the PPE to the fair market value. So times the 1.5 million times 1.2 to get 1.8 million. Adding the difference to the total assets, we get 2.4 million in total assets, and we subtract out the total liabilities of 230,000 to get the valuation of 2.17 million. And I think we'll be able to send out the slides to everybody after. So if you guys want to practice this or leverage it in the future, you're more than welcome to. Next slide. The next valuation method that we're going to talk about, I think, is one that everyone's heard of. It's the relative or market approach. This is where you take a financial metric and then apply a multiple to it. So we've highlighted 3 different financial metrics: EBITDA, revenue, seller discretionary earnings, and gone through it. So the pros with the relative or market approach is that it's what the market's willing to pay. So it's historical transactions typically. So someone has purchased or sold a business at this multiple. So it's very relevant. The cons for this is it's challenging to find companies that adequately represent your business or the business that you're looking to buy. Also, private company data in the small and mid-sized business space is very expensive to come by. Highlighting the bottom metric down here, seller discretionary earnings. This is traditionally for small businesses with revenues less than $2 million. And we're going to go into the next slide on how to calculate these different metrics. So the first step in the relative or market approach is you have to find a multiple. So there's different various sources out there that you guys can leverage. PitchBook being probably the predominant one out there, but also the most expensive one to find the multiple. Then you calculate the metric that you want to use. So revenue, EBITDA, seller discretionary earnings, EBIT, profit. There's a variety of ones that you can use. So, and then from that, you apply the multiple to the metric. So for the first example of EBITDA, for calculating EBITDA, you start with revenue, take out cost of goods sold, then your operating expenses, and add back depreciation and amortization to equate to EBITDA. For the seller discretionary income, again, this is specific for small businesses, revenue less than $2 million. You start from the other half of the income statement, so the net income or net loss, and add back depreciation, amortization, interest expense, and then some of the owner's perks. So this would be the owner's salary, if he or she is running a car through the business, cell phone, these type of things. We have another example. Camila Gonzalez is coming back into play here. She is now considering selling her business within the next 10 years and would like to know how much she can expect to receive. Camila's business generates $5 million in annual sales, and she has an EBITDA margin of 10%. Depreciation and amortization are projected to be $300,000. Camila takes an annual salary of $90,000 and expenses her car, lease, $4,000, health insurance, $5,500, and cell phone, $500 annually. What's the value of her business? So using the first metric multiple of EBITDA, what's the value of her business using EBITDA? So her EBITDA with the EBITDA margin, so revenue is 5 million, the 10% EBITDA margin, we equate to 500,000. We apply the EBITDA multiple of 6 to get to $3 million. The revenue multiple, this one's going to be fairly simple. It's a 1-to-1 ratio, and her revenue is 5 million. So there we go, 5 million. And then the last one, the seller discretionary earnings for small businesses. We'll start with the net income of 300,000 and then add back the depreciation, amortization, and some of the owners, well, all of the owners' perks. And that'll equate to 700,000, and we'll apply the multiple of 4 to equal 2.8 million. Then the next slide, Anoop. So with these multiples, like we touched on, that there's a range, and depending on certain aspects of the business, that which Anoop will touch on later, to determine which multiple in the range you'll select. There's also a timing perspective. Like right now with restaurants, they're probably not going to be trading at the higher multiple of this end. So this is the bit of the art piece of the valuation. Now, the last valuation method that we're going to talk about is the intrinsic or income approach. And this is what uses called a DCF, a discounted cash flow. And what it does is project the business's cash flows forward and discount them to the present value. It's applicable for middle market companies and up, and for forecasting changes to the company. Some of the pros of using this is it lays out the assumptions that the buyer or seller has, and shows how these assumptions will affect the business. Some of the negatives or cons with this is it's not applicable to small businesses because of the number of assumptions out there, although I would argue that it is applicable, but just in general speaking, if you're valuing a small business, most valuers don't use discounted cash flow analysis for the small businesses. So how do we calculate this? So this is going to be kind of like drinking from a fire hose, so just bear with me. I've tried to label it down into 6 steps, but the first step is to forecast the cash flows of the business. And then you discount the cash flows using something called the weighted average cost of capital. And you're discounting the cash flows based on the time value of money. So $1 today is worth more than $1 tomorrow. Then you calculate the terminal value. So the terminal value is the future cash flows of the business beyond the forecasted period. So in this example, it's from 2024 and beyond. And I know that sounds crazy that you're calculating all the cash flows of the business and beyond, but from an academic standpoint and a professional standpoint, this is widely accepted in the community, valuation community. After you calculate terminal value, you discount terminal value to the present value, and then sum it with the discounted cash flows for the projected period to equal your valuation. So we have another example on this, and this one's, we're not going to really go into in depth at all. It'll be more of, let's say, a take-home project if you guys elect to do, but Again, it's with Camila and Gonzalez and highlights her financial metrics, but the idea of this exercise is to solely calculate the unlevered free cash flow of the business. Lastly, after all the valuation methods are used, or the valuation methods that you elect to use, are presented in what's called a football field. And it shows the ranges for each valuation method used. So in this example, the revenue multiplier, you can use 0.75 to 0.2, and this is just based on industry standards. And after you have all the valuations laid out on the football field, usually a line is drawn across, whether this is the mean, the median, a weighted average from which you deem the specific valuation methods are most applicable. And it comes up with a specific value instead of a range. So Camila Gonzalez's value for the examples that we did, her mean valuation using all the methods is 3.23 million. I'm now going to hand it on over back to Anoop.
Yeah, thanks, George. So we're going to zoom out a little bit again from technicalities to a bit more general information. I do want to remind you guys that the process is very iterative. So you start with the purpose in mind. What is the end in mind? So why are you doing the valuation? Who's going to do the valuation? Those are really important to the rest of the process. Then you do what George talked a little bit about, which is gathering all the company information. In this stage, you can choose the quantitative information, the financial data, but you can also, typically when you're doing a valuation, if a certified valuator is doing it, they would really go into the specifics in terms of the qualitative metrics. How experienced is the management? What is the intellectual property? So get all the relevant information to the business. And then the third step is really choosing the methods. We've talked about this in the previous section, but you could choose one, or what we recommend, a combination of methods to get a range of values. Then you actually estimate the values. And then at the final step, you make minor adjustments based on the intangibles of the business or any interest or discount rates. The key in this process is that it's iterative. At every step, it's kind of what we've found useful is to do a sanity check. Sometimes we get too lost in the numbers. Sometimes we get too lost in the narrative. So every time, does this make sense given the context of your business and the industry and the economy? One thing that we like to think and talk about is that valuation is in the eye of the beholder. What we mean by this is that it's not purely objective, it's not a pure science, and it's not also a pure art. We'll be talking about it, but it's really blending the science and the art. We've talked a lot about the numbers and the science. A few things to think about is the business scalable? Is there access to multiple sources of financing? These all influence the valuation tangibly. And then what influences the valuation also, and what we have found as the biggest difference influencing the multipliers, is the arts of valuation. So how is the buyer perceiving any synergy with the business? Is there any proprietary market knowledge that the business has? Are the processes and the people and the business transferable from a buyer to a seller? These all really influence the value and the multiplier. In our experience, both George and I, we've seen multiple transactions fail. These could be due to multiple number of reasons, but we're really focusing in on the due diligence phase. We've seen that after there's an initial interest between a buyer and a seller, and then the seller gets into a due diligence agreement, then there's multiple red flags and deal killers. So we've highlighted some here. We're not going to go through all of them, but probably I'll talk through a couple. One of the biggest things that we've seen on the investor side is really inconsistent narratives or material disclosures late in the due diligence phase. So if you've projected your business as a specific way, but your numbers are not really adding up. If you reveal something at the last moment, that's really a surprise. Investors don't like surprises. So that's something to keep in mind. Another thing is obscure and complicated shareholding structures. We typically see this in family-owned businesses or small businesses. It's not always a deal killer, but it can be a red flag. So if there's multiple subsidiaries, if money is just flowing through like a weird structure, or if there's a lot of related party transactions, these are red flags that investors look at. And then one big deal killer is if there's any unresolved litigation against the company or the owners, investors usually don't want to close that transaction. It's helpful to keep in mind all of these, as they do influence and can make or break your deal. And we are also touching a little bit on the smaller points. Poor bookkeeping or accounting practices. I think it's really important just to get professional help. Which brings me to my next slide, and I'll pass it back to George.
Yeah, thanks, Anoop. So going through the math and all those slides, I'm sure it was a lot, but there is good news out there. You can get professional help. And then there's a variety of different options out there for who you can choose to get professional help. So normally with small businesses, they typically leverage a business broker to help them with their valuation and sell their business if they don't have a buyer in mind. And this type of business broker will traditionally use the seller discretionary earnings model to generate a valuation, and then they'll place the business on their website to try to find a buyer for the business, and then they'll take anywhere from a 10 to 15% transaction fee of that. You can also go to your accountant to see if they'll do your valuation. Not all accountants do valuations, but a lot of times they will have a network of people who can help you with your valuation. You can leverage a certified valuation analyst. Typically what they'll do is do what's called a quality of earnings first to make sure that everything in the books checks out, and then they'll do their valuation. And these type of valuations cost 10 grand and upwards. You can also look to hire a business valuation service provider, but the cost of these service providers and the value they provide greatly vary. So just be completely sure you know what you're getting if you elect to use this service. But lastly, what I would recommend is coming to us, Ennerate. We provide valuation services to small and mid-sized businesses. We also offer a subscription base to those individuals, fractional CFOs, accountants, bookkeepers, business brokers, search funders, really anyone who's looking to do valuations on a monthly basis. Or if you want to do a valuation in a one-off, you can also come to us. So feel free to reach out with any of your valuation questions. I believe we can send everyone the presentation after, so you'll have my contact information there, and I can post it in the chat. But that's all we have for today. We appreciate you taking the time to listen to us in our presentation on business valuations. Hope you enjoyed it. And we'll now open it up to questions if anybody has a question. Feel free to type it in the chat or unmute yourself. If there's no questions, Paulina?
Is Nico speaking? I can't tell.
I don't think.
Can't hear him.
Oh, he's going to type it in the chat.
Oh, okay. We've got some chat messages. Anybody feel free to unmute. Provide some feedback. Have a question?
George, I think that one.
Do you have software, or is this mainly a service? So it depends. So if you're a business broker or a fractional CFO, we provide you with software. If it's a one-off base, we'll give you access to our dashboard to run your metrics through.
In your opinion, what percentage in your historical situations is the science versus the art?
So I would say it's 100% both every time. So the science being the math behind it, so the numbers that go into it, the financial statement, the art being the negotiation process. What really helps is if you have clean books, your documents, your processes and procedures is well documented. And then for the smaller business space, you will trade at a higher multiple if there's separation between the executive team and the business, because buyers will want to go into the business to buy the business, but not be as hands-on, to almost buy it and have it cash flow for them. So this is more of like what Anoop was talking about, the art piece of it.
How involved are you with a negotiation?
So our service, we don't do the negotiation, we provide the valuation, just the valuation. And then Michael, looks like, or Michelle, you were looking about the subscription. Was that too as well?
Yeah, just with if we could get the slide deck with information about the subscription model, that would be great.
Okay, definitely.
George, I think you were going to mention, you said that in your opinion, actually for smaller businesses, the DCF is legitimate. I would love, I don't know if I misunderstood. I would love if you can briefly expand on sort of your take on this.
Right. So if we're talking small businesses, so these are your main street businesses. So your, your mechanic shop, or, your local restaurant or retail shop. Typically for the valuation process, your business broker won't do a discounted cash flow for them. The business broker, he or she, will have access to a database of seller discretionary earnings, transaction multiples. Then you'll work with the business broker to come up with your seller discretionary earning number, and they'll apply the multiple to it. You'll also, after that, probably have to go out to someone, your accountant or bookkeeper, to get 24 months of forecasting if you want to get an SBA loan on top of that. So it's two services that you'll need to leverage there. But in regards to the discounted cash flow, your business broker won't be using a discounted cash flow to generate a valuation of your business normally.
Okay, thank you so much, everyone.
No worries.
Conversation, nice presentation. And yeah, if you'd like to send a slide package over, I can send it to everybody that joined.
Perfect.
And
Sounds
also
good.
with the link of the recording, which I'll put out there on YouTube.
All right. Thanks, everybody.
Thank you for attending, guys. Feel free to reach out.
Thank you.
Thank you so much. That was great.